It's the most considerable concerted rate tightening I believe we've seen in almost all of history. As opposed to, many people using the Goldman measure, which is not that broad because it uses equity markets and it's a weird type of feedback loop to inequities, and that we have the most considerable tightening of financial conditions on a broad measure. However, what I did was the rate of change in interest rates, the rate of change in the value of the dollar, and the rate of change in commodity prices all help you gauge how scarce money is. The number of central banks as a percentage of all major banks' rating rates is another way to look at it. These events give us an impending growth shock that we are already beginning to notice. Welcome back to another exciting video from Surgency. Today's video is about the biggest crisis we've ever seen in history. Before we start the video, please like, subscribe, and press the bell icon. That is very incisive. We're talking about a recession that is quite significant, with a GDP growth decline of roughly 3%. However, forward-looking indicators indicate that the growth shock's bottom may arrive quite soon, perhaps in March 2023. If that's the case, then the recovery side follows. Because we most likely entered a recession at the beginning of this year. It lasts for around 18 months or 2 years. The macro is currently poor and will soon get worse. The story you will witness is that the macros will turn very bad. Every asset must lose value. However, once you start calculating the S&P 500 or Nasdaq's year-over-year rate of change, you see that they are genuinely pricing according to an ISM. The poll by the Institute of Supply Managers, about 40. Therefore, the current recession is quite severe. Could that the price a little bit? Could the number be lower? Sure stab. However, because they are assets with a forward-looking nature, they search for the turn. Why did you turn? Since that is sometime in the upcoming 6 months, most likely, the central banks will disappear. Unemployment is about to occur. Inflation is decreasing. Our mandates, which include addressing unemployment and inflation, must be taken care of. The level of inflation will likely be higher or stickier. It won't, in my opinion, but unemployment is going to be a problem soon, in my opinion. We must at least halt. In other words, if the rate of change slows down, you release the pressure. They don't necessarily erupt more powerfully now. Not the same as in 2021 again. However, if the pressure decreases because of the rate adjustment, the QT halts and they cease raising rates to gauge the problematic situation. Okay. Rate cuts are then likely to occur, or if not, there will at least be stability. Rate increases are unlikely to be made further. Okay. Being forward-looking, that's generally favorable for risk assets. It enters the crypto sphere at that point. Crypto is, therefore, quite intriguing. Similar to technology equities, which have an exponential logarithmic upward tendency due to their models for network adoption. Thus, in the world of technology stocks, we have the relentless, continuous, absurd pace of advancement of artificial intelligence, robotics, EV, space, the Internet of Things, 5G, 6G, and genetic sciences converge simultaneously. The most significant rate of change ever experienced by humans. It's difficult for us as a society to deal with, but it keeps happening. If you can picture it, you have an exponentially growing up trend that is quite attractive and smooth when plotted on a log trend. However, you have these large swings. The macro is what motivates those large fluctuations. We are now at the bottom of the macro cycle due to what we did. Currently, the beach ball is being held submerged. The beach ball rises above the ocean as quantitative tightening or rate increases end. You gotta keep it in place. And since I believe we are I am so fascinated by this specific moment in time right now. Quite nearly where growth I am included. In the US, there have already been 2 rounds of negative GDP. A rollover in housing has already occurred. Issues with the supply chain have already been observed. The majority of commodities prices have already dropped by 50%. The currency has already exploded higher. Because the biggest exporters in the world, Japan, Germany, and China, have all seen their currencies drastically depreciate, the dollar is highly deflationary. As a result, they are now offering finished goods for significantly less money. The macro turn is thus imminent. When we look into chain analytics, we start to notice things that only ever occur in these significant bear market sell-offs, like the ones that occurred in 2014 and 2017 and similar events. Additionally, 2 standard deviations are oversold at the channel's bottom for the logarithmic trend, usually a nice one. The 5-year exponential moving average is where we are. That level has consistently shown to be about the most risk-reward ratio available. If we apply technical analysis, things like these are oversold, as they have been at the bottom of every other cycle. When the macro narrative is at its height, everyone is convinced that inflation will always be 20% and that Europeans will be starving to death in the streets because they cannot afford to heat their homes. Right? At the moment, it is the story. How much worse could things possibly get then? When you reach this confidence of occurrences, the risk-reward typically ranges from 20 to 50 times, depending on the rate of change, depending on where you are on the risk curve now. Contrary to my working premise, I still don't believe the equities markets will hit any meaningful new lows. They might damage that. Go a little lower before breaking higher once more since the sentiment in stocks is unmatched. This will soon appear in global macro investors. In terms of any survey indicator, it is the worst mood in equity markets history. People are so in record bearishness. They are afraid as a result of what is happening. The dollar, the biggest of all macro assets, has also become untethered from the bond market, which is the anchor pricing for everything. It is a frightening situation, but two games are being played from my perspective. One is the gang of guys who want to act crudely and enjoy their moment in the spotlight. But the politicians are a much more potent force. The people who genuinely set good policies are the politicians. Politicians then decide that economic growth has reached an unsustainable level. I think they'll amend the rules, and in that situation, direct aid and other measures to lessen the suffering will be necessary. Not at all. Mortgage rates like these won't last for very long before unemployment sets in, making things difficult for the Biden administration or any other administration in any country to handle. As a result, if the current trend persists, there is a tendency for it to do so. Because there is a tendency for the market to start pricing soon, it will take someone to intervene, just as it did in 2020. Therefore, my belief that politicians will ultimately manipulate the Fed remains unchanged. Given that the conflict they remember is the one fought by the brave hero Paul Volcker, I believe the Fed is to blame for starting this. It's not that fight. They are fighting the incorrect battle. We have a significant issue. You can hear this horse and the people coming to the rescue in the background over the coming weeks as things progress toward their logical conclusion, though, since someone will eventually need to take action. That's all for today. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe to our channel for more exciting content.